So, this is lecture note 3. And this is the first we did for this week. So everything we do in terms of valuation this semester is based on Modigliani-Miller. This is a graphical framework of Modigliani-Miller of which the McKinsey textbook process is based. So what we're primarily saying is a company's worth the sum of its future cash flows, and what we're going to do is we're going to break those cash flows into 2 buckets. One is going to be called operating cash flows, which are basically the cash that comes from selling products and services to customers. The other, non-operating cash flows, which are items of value that the company has, go back to this mode, but have nothing to do with sales. So for example, if I am Merck, right now, Merck has, where's it, cash of about, let's do the latest filing. They got a bunch of cash sitting in overseas accounts, primarily because they didn't want to repatriate and pay taxes. That's about to change under the new U.S. tax laws. So that's the point. If a company has a lot of cash, Microsoft, Apple, Google, whoever, sitting overseas, it has value, but has nothing to do with selling the next product. Okay? So what we're going to do is we're going to value that separately. Same thing. If I am participating in a joint venture, and I don't run the venture, I just own another piece of some other company. Well, that's non-operating. Okay? So it has nothing to do with my sales. So what I'm going to do is I'm going to value the company by looking at its operating performance. I'm going to look at a company based on its non-operating performance. And then what I'm going to do is I'm going to add the 2 together, and that's going to be called enterprise value. Okay? And because they're present valued, I can do that with NPV. Now, there's that cash flow enterprise value that I can then use to pay off my stakeholders. Debt gets the first claim. After the debt holders are paid, whatever's left as residual goes to the shareholders, divided by share price. That is enterprise DCF in a nutshell. That's the process we're going to use this semester. And so that comes from Modigliani-Miller. So in order to do this very straightforward process, we have to put our financial statements into this cash flow format. Okay? So this is a map process this semester, all on one page. So what's different about this class and McKinsey's approach than just about any other class you would take is that we're adding an intermediate step to the valuation. Okay? So what most people have taught you in the past, they said just go straight from the statements to the cash flows. Right? But what we're going to do is we're going to go from the statements to economic statements, economic being a rearranged cash flow statements, and then we're going to do the valuations. Okay? So here's the thing. The statements, income statement and balance sheet, are going to be rearranged, the income statement into a statement called TII, total income available to investors, and TFI, total funds available to investors. Those are basically Modigliani-Miller formatted statements. Operating, non-operating, debt, equity. Okay? So the first step is going to basically be take the statements and put them into those 4 buckets. Right? And then the other thing is what's unique about this class is I used to teach in the McKinsey Analyst Training Program. And I'd have 4 hours to basically teach 30 to 45 very smart undergrads who have never taken a business class. So they could be pre-med, English majors, physicists, engineers, and I had to teach them how to do this in 4 hours. And it wasn't easy because they'd never taken accounting either. So I used a mnemonic, which you're going to find doesn't exist anywhere. You talk about this mnemonic, otherwise, they're just going to look at you like you're nuts, right? But I think it will help you. And so here's my mnemonic, right? When I went through these 4 steps, I called the operations 1. So anything that's an operating cash flow 1. Anything that's a non-operating cash flow is called a 2. Anything that's a debt cash flow is called a 3. And anything that's an equity cash flow is called a 4. 1 plus 2 equals 3 plus 4. As a matter of fact, if you do DCF, it's 1 plus 2 minus 3 equals 4. Right? But the whole reason for this is it's a process called labeling, which is what we're about to do. So if you took a toy made of Legos and you ripped it apart and you put it back together, what's going to be key is there can be no Legos on the floor. Right? And that's what I mean by balancing statements. So if we start with balancing statements, we have to end with balancing statements. We can't forget any accounts. So what the labels will do, if you follow my suggestion, you don't have to, but I would think it would hurt you if you didn't. But basically, follow my suggestion, the labels will help you put things in the right place. And it'll make sure that when it doesn't balance, you can go back and you can say, aha, there's 4 ones on the balance sheet, but I only have 3 ones on the TFI. So I forgot to put a Lego into the new toy. So it will help you when you're frustrated trying to balance these statements. If you think you're the pro and you want to skip this, by all means, if you get it right, that's fine. But I just find, even today, when I deal with very complicated statements, it's easier for me to think of it this way. It's the way I structure it. So back to this. So here's what we're going to do. We're going to take the income statement. We're going to break it up into 4 parts. Operating items, no plat. Non-operating items, non-operating income. Debt payments, interest expense. Equity payments, net income. We're going to take the balance sheet, do the same thing. Basically, operating items, net of operating liabilities, assets minus liabilities, is going to be called invested capital. Non-operating assets, net of non-operating liabilities, are going to be called non-operating capital. Add the two together, total funds available to investors. That's going to equal the debt financing and the equity financing of the business. Right? It doesn't matter whether you do the income statement or the balance sheet first. But what does matter is you'll need both of those converted statements to create statement number 3, which is called CFI, the cash flow available to investors. And this is core to the valuation. Cash flow is basically income statement minus change in balance sheet. And that's just the nature of cash flow. So here's the point. If I take my no plat minus my change in invested capital, I get my free cash flow. Right? If I take my non-operating income, change in non-operating assets, I get my non-operating cash flow. Add the two together, CFI. Okay, yes? Yeah, and unfortunately for purposes of the video, when I go full screen, it only records like a quarter of the screen. So you should have this in your lecture notes if you want to download and follow along. Sorry about being able to see it. It's just a limitation of the 10-year-old technology in this lab and that monitor, which goes on the fritz most of the time. So, long story short, it was state-of-the-art when we first started teaching in here, by the way. Even those things used to work before they had to rip them out from the wall because the fans were about to explode. All right, so back to CFI. So if you take the debt payments to the income statement, change in debt in the balance sheet, cash to debt holders, dividends minus change in equity, cash flow to shareholders. And so that's the point. If we forecast our free cash flows and discount them, operating value. Forecast non-operating cash flows, non-operating value, add the two together, enterprise value. Right? And that's the distribution to the debt holders. I can work across, I can work up and down, but that's where we need to end up in the valuation. So in order to do the valuation, we got to get through this middle process. By going through the middle process, you'll get 2 benefits. Number 1, you're less likely to make a mistake. Because here's the problem that you've learned in previous classes. When you calculate free cash flow, you stop at free cash flow. So if you accidentally forget to put something into that free cash flow, you'll never know. You just make that mistake, right? In this process, you won't make that mistake because not only will you forecast the free cash flow, but you're going to forecast the other side of the cash flow where it went. And those two must balance. All right, so if I had 100 of cash flow, I have 100 of distribution to my investors, and 100 needs to add up to 100. If they don't add up, I miss something. So this process, though frustrating, actually makes for better analysis. The other thing is, think about ROIC. There's my no plat, there's my invested capital completely stripped out. That's my operating ROIC. So it also gives us much cleaner ratios and much cleaner analytics. So it'll suck as a process, but you'll realize the value later on as we use it throughout the semester. So the other insight I want to give before we get into the process is the difference between our ROIC in this class, which we'll call the operating ROIC, and what you learned in previous classes, which is the rest of the world, including Bloomberg, just calls ROIC. Right? And what they say ROIC is the return on the debt and equity, right? Which is the return on all of the assets. But what's important here is we actually want to look at the return on the operating assets and the return on the non-operating assets, which averages out to what the rest of the world calls ROIC. And I'll give you an example of why this is important. So a few years ago, I was working with a company called Molson Coors. So here's Molson Coors. and here are their peers. And using the homework 1 file that you just did, this is their spread. Okay, that's the industry. Is this an attractive industry? This is beer, beverages. Looks decent. Yeah, it's positive spread, attractive. Does Molson Coors demonstrate advantage? No. So here's the situation 3 years ago. So another cool feature of Bloomberg, by the way. Add a column, ROIC. But what I'm going to do is I'm going to do customize period to years ago. I'm going to go to year minus 3. So this is 3 years ago when I was working with them. So that was their ROIC then, 544. And the WACC hasn't changed all that much. So is that attractive? That was pretty bad. Yeah, they've obviously improved. So here's the point. When I was working with them and they had the 544, they were getting ready to gut the company. All right, the axe was out. They were about to lay off a bunch of people, shut down some plants, reorganize, because basically Wall Street was putting a huge amount of pressure on the company saying you were an underperformer. And I was actually brought down to Fort Lauderdale to give a keynote speech to their leadership. And what I actually told them is, you're not doing as poorly as you think you are. Because what I said is, look at the operating ROIC and non-operating ROIC separately. Because this is the blend of the two. It's the company's return. This is the way Wall Street looks at it. However, if I look at the operating ROIC, and this is a custom field that you will learn how to create in Bloomberg, upcoming homework assignment. That's why Wednesday's class is important. It's 18%. I know, mixing time periods, but it really didn't change that much. So yes, they're still underperforming the industry, but 18% is well above their cost of capital. And that's the beer business. That's what they make by selling beer, right? Then they have some non-operating assets, and when you put the returns of the non-operating assets and the beer business together, they make 5%. But here was an example of a company that was ready to gut the beer business because they thought the beer business was making 5% when it was actually making 18%. And if you wonder why McKinsey is so good, that's what McKinsey does that the banks don't do. Because the banks will go in and beat you up over the 5%. And they're making 5%. But the company did not understand that the 5% was not the beer business. The beer business was making 18%. So here's the point. If the operating return is 18% and the average of the two is 5%, what does that say about the non-operating return? It's negative. It's terrible. Okay? So basically that's the problem. The problem was the non-operating assets. So what I actually looked up is they, at the time, had a big black hole of a joint venture called SAB Miller, right? And they put huge amount, hundreds of millions of dollars. This joint venture wasn't making any money. And it was killing the results of the company. But the problem was not the beer business. It was the joint venture. But everybody thought it was the company because they were just looking at the company ROIC. And I'm not saying that that's the way that investors aren't going to judge you. Because as an investor, I gave you cash, make the money. I don't care how you make it, you owe me. That's ROIC. But from an insight standpoint, the operating values, the non-operating values are different, and they go up at separate rates, which means we're going to forecast them differently. So if Molson Coors were to gut the SAB Miller acquisition by selling it to Anheuser-Busch InBev and start focusing on beers, selling beer, is it any surprise that 3 years later they went as a company from 5 to 11? Because they just had more of the 18 in their business mix, right? So that's what I mean by we get better insight. And to some degree, it goes back to the question you asked earlier, which is if I think future-oriented, I'm making 5 now. If I keep selling beer at 18, my 5 is going to go up. And that's exactly what has happened to Molson Coors. Does that make sense to everybody? So that's another reason why we're doing this labeling process, because by labeling, we'll get a much clearer view of what this operating ROIC is. And we'll understand what the non-operating ROIC is, because we'll have broken it out, okay, by rearranging the statements. So let's talk about the statements. This is covered in the book, but we're going to use the simple example that's right out of the book for the balance sheet and the income statement. Let's start with the balance sheet. I've done this in the previous class. Let me wipe these out. Okay, so you're going to do this in Excel, and this will be very similar to the midterm, except it'll just be bigger and scarier. But the process is still the same. All right. So here's the thing. First thing we want to do, so we wipe these out, is go through a process called labeling, which will help us. So 1, 2, 3, 4. Operating, not our ones. Non-operating cash flows, 2s. Debt cash flows, 3s. Equity cash flows, 4s. 1, 2, 3, 4. Cash on a balance sheet. 1, 2, 3, or 4.
1.
1. All right. So for purpose of this exercise, 1. But here's the trick: cash is a 1 or a 2. Could also be excess cash, which is non-operating. All right. So on the midterm and on your homework, it'll say operating cash and excess cash. Operating cash is 1. Excess cash is 2. So again, here's the way I think of it. One of my first jobs in high school was drive-through at Burger King. This is back in the day when people weren't using as many credit cards. So at the beginning of my shift, the manager and I would count my till in the office. We'd walk it out to the register, put it in the register, and he'd basically turn a knob to say, start the register all over with this amount of cash in it. I'd run my shift. At the end of the shift, turn the knob, print out, back in the day, not computers, basically print out the amount of stuff that was bought. We'd take it to the back. We'd count the cash. He'd leave the same amount that I started with, and he'd take out the rest. Okay, so in the till. And so here's the point. The money that was in the till that never left the till is called operating cash. All right, because the Burger King franchise could never pay that out for salaries. They couldn't use it for anything else because they actually needed it to make change as part of their business. So that's the idea of operating cash. Is the same is true for companies. Is that there's just some amount of cash that a company can never pay out. Right? So net debt is a misnomer. It is completely unrealistic to take debt minus cash. You can't give all of your cash to the debt holders. Right? It just wouldn't happen. Because, for example, if you were to go bankrupt, right, the first people to get paid are the lawyers. Then the government's going to want their unpaid taxes. Then you got to pay the unpaid wages. Then you got to pay your suppliers. Then you get to the secured lenders. So I'm just telling you, there is no circumstance where a company will ever be able to pay all of its cash back out to the debt holders. Just won't happen. And even if they went bankrupt, it couldn't happen. So we will make shortcuts in the real world. You were taught a shortcut that people use in the real world. In this class, we're going to get more granular. Now, it doesn't mean that if you go work at your first banking job that you tell your partners that they're wrong, they'll get you fired out of arrogance. But what I'm telling you is at least you'll know that they're taking a shortcut when you're going through these analytics, because we're going to do it the more academic way. So back to this. So operating cash, 1, excess cash, 2. But for purpose of this example, we're just going to call it operating because it's a very simple example. All right, inventory. Is it operating or non-operating? Operating if it goes to customers. So inventory is basically what they're buying, so that's 1. Property, plant, equipment. Operating or non-operating? 1 or 2? Well, we manufacture the goods in a plant. That's obviously operating, so that's a 1. Equity investment in another business. That's a 2. Microsoft buys a piece of Facebook, right? They don't run Facebook. They just happen to own a piece of Facebook. Made a lot of money off of it. But that's the point. It's non-operating. Okay? Has value, just valued separately. We'll call that a 2. You don't value the totals. Accounts payable. Part of working capital. It's going to be a 1. It's operating. And I'll give you the distinction. Interest-bearing debt is a 3. If it's non-interest bearing, it's probably accounts payable or something like that. If it's interest bearing, then it's financing. It's debt. That's the distinction that we will use. Right? And then finally, retained earnings. 1, 2, 3, or 4. That's equity. Right? So again, very simple statement. The one you'll have more complex, but this is the process that you'll go through. Now, this question came up at the end of last class. For purposes of the midterm, for purposes of the homework, I'm going to give you the labels, right? So I'll tell you what the labels are. But the reason why I'm mentioning the labeling process is very soon, when we go to real-world statements, somebody's going to give you statements that you don't know what the labels are. And you're going to open up, P&G statement. It's going to say other assets. And we got to figure out, is that operating or is that non-operating? right? Because the companies don't tell us, the accountants don't tell us, so we're going to have to figure that stuff out. So that's why I want to get this in the back of your mind, that these are square pegs that we have to put into round holes as we go through these statements, right? But nonetheless, I'll give it to you for the midterm. But this is an important process, and here's how it will help you. So now we want to create a new tab. I recommend when you do these assignments, 1 tab per answer. Okay, just be easier to grade and easier for you to do. It also allows you to cut and paste, which is what I'm about to do. So the years, copy and paste them. Copy, paste the years. So now what I do is I assemble my Legos. Take all of my ones, all my operating assets, net of my operating liabilities. So cash, inventory, PP&E, and liability ones equals accounts payable. Notice how all my ones are together. All right, and this is the other reason why labels are helpful, because it shows I put all my operating items together. Okay, so what is my, in this case, invested capital, or actually I'm going to add a word in front of it to distinguish what is my operating invested capital. That's probably the better way of saying this. It's going to be the sum of the assets minus any liabilities. 380, 440. So very quickly, we have invested capital. That's how much is tied up in the operating assets, right? Now I need to do the same thing for the non-operating items. Do I have any twos? Do I have any twos in the asset side? Equity investments. Do I have any twos in the liability side? No. But you will on your midterm and on your homework. Okay, so just like we net the liabilities against the assets for the operating, we do the same thing for the non-operating. We don't have any here, so non-operating capital equals assets minus liabilities, since we only have assets, 15 and 25. So then we have TFI, total funds available to investors, is the operating invested capital plus the non-operating capital, 395 and 465. Okay, so now we go to the other side of the statement, the 3s and 4s. How are we financing those assets? Okay, this is the rearranged financing or funds flow side of the statement. So we're financing them with debt. So do I have any debt? The answer is yes. Those are my 3s. And do I have any equity? And the answer is yes. Retained earnings, those are my 4s. And when I add up my 3s and 4s, stop Excel. When I add up my 3s and 4s, notice balance, balance. This is what I mean by balancing. Okay, so in this class, very important. Let's say for some strange reason you forgot to put your 2s in here. That's an incorrect answer. Even though one of those 2 numbers is correct, and even though when I ask on the exam, I might say, put in the TFI for this year, and you put in the right answer because you had a 50-50 probability of getting it right, you still get a 0 for the question, right? Because you only had a 50-50 probability of getting it right. You don't know if 395 or 380 is the right answer. Even if you put in 395, that's still a guess. The only way you know 395 is the answer is if both sides balance. So that is true throughout the entire semester. And that's what I mean by balancing statements, because if we only do one side, we don't know if we made a mistake. If you balance it, you clearly know you made a mistake. And this is where labeling can help you, because when I'm searching for what mistake did I make, oh, I forgot to put in my 2s. I don't see any 2s here. I saw 2s on the other statement. Or I have 4 1s on the other statement, but only have 3 1s on this statement. So I forgot a 1. And that's where labels can actually be very helpful in this process. So that's the point. Let's undo, undo. And now we have a statement. We have basically 380 of operating assets, 15 of non-operating, which is 395, which is financed by 225 of debt and 175 of equity. Okay, just cleaner views of the statements mapped to Modigliani-Miller. Questions?
So again, the non-operating cash flows are just equity minus non-operating liabilities.
The non-operating assets, non-operating capital, not cash flow. It's just non-operating assets minus non-operating liabilities. So operating assets minus operating liabilities. Okay, there just wasn't any in this example for the non-operating. All right, statement number 2. Rearranged income statement is called TII. Total income available to investors. All right, so I'm going to copy the years. Copy and pasting will save you a lot of time and be necessary to complete these assignments. So we got to label our income statement. Start out with revenue. Operating, non-operating. Yeah, it's coming from customers, so it's probably operating. Operating costs, so manufacturing products sold. Operating. Depreciation.
No.
Where does depreciation come from in the balance sheet?
It's a cost allocation, but it's not actually cash.
But what is depreciation coming from? PP&E. So therefore, if it's a same account on the balance sheet, same account on the income statement, it's operating the balance sheet, operating the income statement. It's got to be a 1. I don't like shortcuts, but here's one I'll let you take. Operating profit. We don't do the sum of the categories, but nonetheless, since everything above operating profit by definition should be operating, then you could start here in your conversion. So instead of putting in revenue, operating costs, depreciation, we could just start with operating profit. All right? I'm not going to play around in the midterm or homework. Like, you could start there. In the real world, though, we got to be careful. Because in the real world, an accountant could throw something that's non-operating into the operating profit line. You got to be careful for that. So nonetheless, for here, I'm not going to trick you as you start to think about the statements. So therefore, as a shortcut, we can start with operating profit. Interest expense. 1, 2, 3, or 4? 3, because it matches to the debt. What if it were interest income? It would actually be a 2. Why would it be a 2?
Because it's cash flow from an investment.
And where does the interest income come from?
From a holding that's not part of your.
Yeah, it comes from holding the excess cash, which would also be a non-operating asset. So that's the point. Here's another shortcut. People will do a net interest expense. They'll take interest income minus interest expense, net interest expense. But what they're actually doing is they're merging or commingling non-operating cash flows with debt cash flows, right? And that's what I'm saying. You'll quickly get that insight in this class. Not saying it's wrong, it just happens to be a shortcut for the way they decided to do that, right? But in this class, we will separate it out more by the type that it really is. Okay, equity income. Microsoft's ownership stake in Facebook. You get some dividends on that. 1, 2, 3, or 4. That would be a 2. Tax. Income tax. 1. It's also a 2. It's also a 3. So one of the things we're going to do is we're going to split out the tax impacts to the areas of Modigliani-Miller. We'll still have the same taxes, but we're going to look at the same tax impact in each of the areas. Right? Finally, net income belongs to the shareholders. That's a 4. Now, dividends are the cash flow of the shareholders. However, on the TII, the statement actually ends with net income. So if you try to put dividends, which are coming off the statement of cash flow, into your income statement, you'll never balance your TII. Okay? Because the TII stops with net income. Okay? It's an income statement only statement. So, back to this. TII. Start out shortcut operating income, operating profit. That was our 1. I suggest writing this out granularly because the book doesn't always do this. So if we reported 280 of income and our tax rate was 25%, which is the assumed tax rate I gave you on the tab. Tax on operating profit is basically 25% of the 280. So our NOPAT, or McKinsey calls this NOPLAT, those are pretty much interchangeable terms. NOPLAT's the McKinsey term, NOPAT's the rest of the world generic term, basically is 210. I make 280, I pay 70 in taxes, I have 210 of after-tax profit from operating activities. Okay? I do the same thing with my non-operating activities. So I have my twos, equity income. I make $4 million of equity income. I have tax on non-operating income equals that times the 0.25 after tax non-operating income. TII, the operating plus the non-operating, 213. Now here's why I'm writing this out. Happen to know one of the authors of the book, was just actually working with him on this Google program. His name is Dave Wessels. He is now a professor at Wharton. He wrote a lot of the edits of the 5th, 6th edition. So here's my problem with what Dave did. Real smart guy, but it's so ingrained in him by working at McKinsey as long as he did, that if you actually look at the example in the book that I'm following here for the TII, you'll see a 4 here, you'll see a 3 here. And you wonder how the 4 became a 3, right? In his mind, it's intuitive to take equals the income pre-tax times 1 minus the tax rate, and that's your after-tax income, right? But what I'm telling you is for your own benefit. It might be helpful to be more granular. I make this income, I pay this tax, this is what's left. Now, if you want to be, like I said, you want to sport through a shortcut, you want to say after-tax non-operating income is equity income times 1 minus the tax rate, great, have at it. But I'm just telling you, it will help you as you go through the process to clearly see what's happening here. And what I'm saying is, I think Dave, when he did that chart, did a little disservice because it's just so intuitive to him that you do that, but it's not intuitive to the person who's never seen this before that that's what was done. But that's actually how the 4 became a 3 in the book, or in the example we're doing. Right? So we have TII. Here's the other thing you just got to wrap your heads around. This is not accounting. Okay? This is Modigliani Miller. It's a completely different world. The way these statements were set up for both the income and the cash flow. If I have income, I distribute the income. If I lose money, I borrow the loss. Okay? Therefore, positive income available to investors is going to be distributed, and they have to match. Therefore, distributions are positive numbers. Negative losses of income have to be financed. They have to match. Therefore, any financing that the business does is a negative number on this statement. It's not an absolute value number. It's literally they have to match. Okay, so here's what I mean by that. When we do our 3s and 4s, my 3 was the interest expense of $20, $20 million. Is that a positive or a negative number? Given what I said, should that on this statement be a positive or a negative number? It's a distribution. Therefore, I have 213 of cash. I therefore have 20 to distribute. It's a positive number. I can only tell you that this is something you'll have to use your common sense on because different statements give it to you in different formats. Okay, and you have to think about what the number should be doing, and you come up with the sign on this reorganized statement. Okay, so that's our interest expense. Except what I want is not the 20. What I want is there's going to be a tax shield. I can still deduct as a company interest as a cost of doing business. So I'm going to deduct the 20 at a 25% tax rate, and I'm going to save $5 million in tax shield. So my after-tax interest expense is 15. And then my equity cash flow is my net income. It's my 4. Three plus 4 match. I have 213 of profit. I distribute 15 to the debt holders. I distribute 198 of the profit to the shareholders. Right? And the 213 of profit came 210 from operations, 3 from non-operating activities. That's Modigliani Miller. That's the clean lines we now have into the company's financial performance. Questions about that? This is what I mean by matching. Yes.
Just for clarification, so if the TII is a positive number, you're saying that the debt should be a positive number, and then if it's a negative, then it should be a negative number?
So here's what I'm saying, and it's hard for the people that are watching this on video to see, but I'm holding in my hand a $20 bill. So my example is this. I'm the company, hypothetically. You are the sole shareholder. Okay? I make $20. Right? I give you, the shareholder, $20. The statement's got to balance. So I have 20. How do I balance with you of 20? Do I put it as positive or negative? No. Because I'd have positive 20 on one side, negative 20 on the other side. The only way it's going to balance is if I have positive 20 and I give you 20, so my distribution to you is a positive 20. Right? If I needed 20 from you, you'd be out 20, negative 20, and I would have to record that as negative 20 to me, and that would actually be an increase in my equity, right? Because that would be the point. I'm funding the increase in equity because I'm out of cash. So it's a negative cash flow to you, the investor, and it's a positive cash flow to the firm, right? So therefore, sorry, negative cash flow to the firm because it's basically negative financing. So I'm saying this is not accounting, and what's going to screw you up is you're going to think of statement of cash flows. And you got to get that out of your mind because this ain't that. Okay? This is a completely different statement, Modigliani Miller. And this is true for TFI. This is true for CFI. Or sorry, TII, CFI. So positive cash flow, positive numbers on the distribution side. Negative cash flow, negative income, negative numbers on the financing side. Okay? That's just the way these statements are structured. All right, other questions? Yes.
Yeah, so could you just think about this as like these are the statements with respect to you as the like financer or like that?
Yes, that is the perspective that we're taking. That's exactly the way I think about this. Okay. All right, here's the one that's going to be a little bit more difficult, which is CFI, and this is where you will struggle more. Let's start out with the years. The process for cash flow available to investors is very straightforward. You're going to do it 4 times, once per section. Cash flow from the income statement minus change in the balance sheet. All right? Because if you think about an income statement, it's a period statement, things that happen over a period of time. A balance sheet's a snapshot statement. So basically, the income statement explains what happens between 2 snapshots. So it's snapshot balance sheet 1, income statement, snapshot balance sheet 2, result of the income statement. That's essentially what accounting is doing. So when you go through these statements, we got to look at both the income statement and the balance sheet to do the cash flow. That's why you have to do both of those first 2 first. So let's start out. To get to gross cash flow, TII, start out with your dough plat. Then we add back depreciation, non-cash item. No plat plus depreciation equals gross cash flow. That's the gross cash flow from the income statement. So again, just practically, We subtract depreciation to get a lower basis for taxes. We pay taxes, but it was a non-cash item, so that's why we're adding it back. Okay, so this is how much cash profit they made from the income statement. Then the gross investment is the reinvestment back into the balance sheet. So how do we do that? Well, the reinvestment in the balance sheet is off the TFI, the difference in the, for operating purposes, the current operating invested capital, so that's C6, why Excel doing this, minus TFI B6, so current minus previous year, so that's our gross investment, okay? Except what we're then going to do is we're going to add in our TII data. We're going to add in our depreciation. It's a negative number. I need to double negative it to add it. So we're going to have 80 of gross investment. Okay, so that's just the formula from the book. Change in operating invested capital plus current year's depreciation is your gross investment. Okay, so that will get you your free cash flow, which is the 230 minus the 80. Okay, then we'll do our non-operating cash flow. Off the income statement, TII. What is that? After-tax non-operating income. So we had $3 million of after-tax non-operating income. Then change in the balance sheet. In the balance sheet. So change in non-operating capital. Our non-operating capital went from 15 to 25. Increased by 10. What is it? It's 15 to 25. Increased by 10. Now, question about the signs. Again, I don't have a good way of saying this. Otherwise, you got to think this through. Back to the name of the statement. Cash flow available to pay investors. CFI. Okay? If we make $3 million of after-tax non-operating income, does that add to the cash flow available to pay investors, or does that take away? We're going to add that in. If I increase my purchase of non-operating assets by $10 million, does that add to the cash flow available, or does that take away? Takes away. So this is going to be a negative. This is what I mean by using common sense to think through the signs. So my CFI is going to be the sum of these three line items, 143. Now, on the financing funds flow financing side, I got to balance the 143. So again, my cash flow to the debt holders, TII, is my after-tax interest expense. Of the 143 of cash I had available, I paid net of 15 to the interest expense. Right? Then change in debt. My debt went from 225 to 200. So did I borrow debt or pay off debt? Paid off 25. That's a distribution to the investor. So is that a positive or negative 25? That's a positive 25. Flip the sign. Next trick. Equity. Net income is not the cash flow that's distributed to the investor. What is the cash flow that's distributed to the investor called? Dividends. So here's the trick to the CFI, first of two tricks. Trick number one, dividends, not net income. On the TII, you use net income because you're balancing an income statement. But in the cash flow statement, the net income is not what's paid to the shareholder, therefore we need the dividends. So the cash flow to the shareholder is the dividends. And because that's a distribution to the shareholder, that should be a positive number. And then we have change in other equity accounts off the balance sheet. So change in equity, which is basically changed in retained earnings. And retained earnings went from 170 to 265. So equity went up. So technically that should be an inflow. So that should be a negative. So if we now add up these, we should get 143. And with the balancing statement, we are done.
48.
No, it should be 143. So I made a mistake. This doesn't balance. Oh, maybe I have the wrong sign here. Nope. So this is why you can't just manipulate numbers for 3 hours and hope you get a final answer. Because if I keep changing it, it doesn't actually balance. So what's the problem here? What is retained earnings?
The part of equity reinvested in the business.
Okay. Is it a cash account?
No.
So if I have a change in a non-cash account, does that affect cash flow?
No.
There you go. Don't put changes in non-cash accounts on a cash flow statement, because then your cash flow will never balance. Change in retained earnings has no impact on cash flow. So there's the other trick number 2. So trick number 1 is dividends, not net income. Trick number 2, don't put in change in retained earnings, because changes in non-cash accounts do not affect cash flow. And I'm telling you, if you don't do those 2 things, you'll never get to this balance. And then you'll either complete the homework assignment in an hour, or you complete it in 5 hours and give up. This is the 5 hours and give up problem. So I'm letting you know now how not to take 5 hours to do this. Okay. By the way, skip this earlier. If I go back to my TII, this is why balancing is important. How much tax did we pay off the original income statement? 66. Even when we rearrange the tax, how much tax are we paying on non-operating activities or operating activities? Non-operating activities. What's 70 plus 1? We save 5 in a tax shield. What's 71 minus 5? 66. So that's the point. We're still representing matching taxes. We're just splitting them out to the areas that they impact. Much more insightful. Because now I know how much I save by having debt in my cap structure. It's very clear for doing that. All right. Final statement. Economic profit. EP. This is McKinsey's version of EVA, because basically we can't call it EVA because Stern Stewart has a trademark on it. So the non-trademark term is called economic profit. Okay. So economic profit, really straightforward to calculate. Again, matching 2 methodologies. Copy over the years. Okay, so here's what we're going to do. We're going to take our no-plats. And then we're going to take our invested capital, the operating invested capital, and we're going to calculate what's called a BOY, which stands for beginning of year ROIC. This is what's on the homework. This is what's on the midterm. What does that mean? It means we take our current year no-plat and we divide by previous year invested capital. That's BOY. If we said end of year, current year no-plat divided by current year capital. Okay? You can do that. You can do an average. We're going to choose BOY so we can consistently do it, and it will match the valuations. So that's the ROIC of the operating part of the business for the current year. Okay, so I'll give you a whack. I forgot to put one in this simple example, but let's say I'll give you the whack of 10%. So you'll come up with a spread, which is the ROIC minus the whack. So that's your spread.
Put 2 negatives.
Hate this keyboard. All right, so I got the spread. And then finally, what is my economic profit? It's my spread times my beginning of year invested capital. Or, method 2, I take my NOPLAT, and I subtract what's called a capital charge. Can't spell charge. So what is a capital charge? Well, I'm tying up 380 capital, beginning of year, times a 10% WACC. I need to make 38 to pay back the investors their expectations. I made 210. The difference $172. Okay? So one's called the spread method, ROIC minus WACC times capital. One's called the capital charge method, NOPLAT minus capital charge equals economic profit. They balance. 4 statements, 4 balancing statements. That's going to be your next homework. This is exactly midterm 1. The only difference, you got 90 minutes next Monday. So practice.